Hi, everybody. Welcome to what I think we'll call Tax Fact Friday. I saw something in the news yesterday that I wanted to mention briefly. It's something that's a bit of a pet peeve of mine from a couple of perspectives. One, it points out how a lot of people don't really understand how the tax law works in terms of timing of income and deductions, and also points out how a lot of what we see and hear in the news in terms of what may be going on in Washington in terms of potential tax changes, increases, what we're hearing a lot about this year, is really political theater. As a lot of people know, there is the potential, or at least the president mentioned back during the campaign, and it's come up again more than once, that among the many things that he may be seeking in terms of tax increases would be a change in the corporate income tax rate from the current 21% up to a possible top rate of 28%. You may remember that the rates actually went down or were changed a few years ago with the Tax Cuts and Jobs Act from a graduated scale that went up to as much as 35% down to a flat 21%. Again, the proposal is to take that back up to 28%. There's news this week that there was a discussion that might come off the table, or the president might be willing to take that rate increase off the table and replace it with some sort of a minimum tax, maybe 15% on possibly corporate book income. And this got me thinking about, and the Tax Foundation and some others have actually talked about this as well, that there are fundamental differences in how income is computed for book purposes versus for tax purposes. There are good reasons for this. You hear tax loopholes mentioned a lot in the news. You know, the biggest corporations don't pay any income tax. First of all, that is not true. It's a gross oversimplification at best. You hear terms like tax loopholes. There's really no such thing as tax loopholes. These corporations that we hear about that pay little to no income tax, if and when that happens, it's because they are using, in most cases, they're properly following the tax law. There are rules in terms of loss carryforwards, how things like depreciation and amortization work. There are periods and methods rules for tax purposes that differ from the rules for book purposes, generally accepted accounting principles, and they are there for a reason. So this discussion of a minimum tax on income, it brings back up the specter of the alternative minimum tax, and it also ignores the fact that there are good reasons for differences between taxable income and book income. It's really taking the rate increase and dressing it up as something else, trying to get back to the same place. And I'm not here to argue whether that is right or whether that's wrong. I'm just saying, let's call it what it is. It's rate increase. I think trying to mask it in terms of a minimum tax on book income is problematic in that it ignores the very real and good differences between taxable income and book income, and it continues this false narrative of tax loopholes that evil corporations take advantage of to pay little to no income tax. There's a lot more I could say on this, and there's a lot more that we could say about the proposed income tax and other changes that the administration is seeking this year. There's a lot to talk about. I'm going to try to do this sort of thing more regularly to discuss some of these, but today I just wanted to mention a little bit about the differences between taxable income and book income, and the fallacy of the use of the term tax loopholes in explaining what a lot of corporations do. And of course, one other point to remember is this is just talking about corporations in terms of the 21%, the 28%, this proposed minimum tax on corporations. This is ignoring individuals' pass-through income, and that's a whole other series of conversations, because really the engine of small business, or the engine of the economy in the U.S. is very largely based on small businesses, which are overwhelmingly set up as pass-through entities. So the things on the table in terms of potential tax increases in individual income tax rates, potential restrictions on the qualified business income deduction, those things matter very much there. But what I'm talking about right now is this minimum tax on corporations in terms of using book income to measure that, and why that really is problematic. It overcomplicates the discussion, and it perpetuates this fallacy of tax loopholes. That's it for, again, what we'll call Tax Fact Friday. Hope to talk more about the potential things that we may be seeing in the income tax world in the near future. Thanks.